Hello, I'm Alex Davies, founder of Wealth Club, and today I'm with Jonathan Moyes, our head of investment research, to discuss private equity. What is it, why you might want some of it in your portfolio, and how you can use our new fund supermarket to access some of the best private equity funds in the world. So I suspect, like lots of our clients, I've got lots and lots of different investments, whether that's stock shares, EIS, VCTs, property. But until recently, I've never held private equity in the conventional sense. So why should people like me start investing in private equity? Why should we really care about this?
So really, well, taking a step back, I think private equity, it's simply investing in companies that aren't listed on a stock market. Increasingly, that's by choice. There's plenty of capital available in private markets. They don't need to list on public markets. It's actually far easier to run a business privately than publicly. And if you look at the numbers, the opportunities are vast in private markets. So if you just look at all the companies in the world that generate revenues of 100 million or more, there's 19,000 companies on stock markets that do that, but there's over 140,000 private companies that achieve that. So the opportunity set's enormous. And so that's one reason why investors should consider private equity. Another is many of the world's best investors live in private markets. If you want to invest alongside them, you've got to invest in private equity. And then thirdly, I think track record. If you look back at what private equity has achieved over the past couple of decades, over the past 25 years, they've outperformed public markets by 6 to 8% per annum. So to put that into context, if you look at a hypothetical portfolio of $10,000 growing for 25 years, if it was invested in global equity funds, it would now be worth around $37,000. And if it was invested in the average private equity fund, it would now be worth around $200,000. Now, clearly, historic performance is just one factor. Past performance is no guide to the future. But I think it does go to show the opportunity set that if you're just limiting yourself to those 19,000 public companies, there's a huge opportunity set that you could be missing there.
So we're missing out. Why hasn't it more been on our radar?
I think historically that's all down to how the industry has structured private equity funds. It's been an incredibly unfriendly structure for private investors. It's these limited partnership structures where you make capital commitments and your capital is called steadily over a period of 3 to 4 years. Minimum investment amounts of 5 to 10 million are common, sometimes more than 10 million. And if you want to invest in a whole range of funds, it's just not feasible for private investors. So I think historically, it's just not been an asset class that private investors could consider. And so if you're a financial journalist and you know your readership can't consider these investments, well, then you're not going to write about them. People aren't going to be interested. And so you have this situation where even though it's an enormous asset class with trillions of dollars invested, it falls under the radar of the average private investor because it's just not something they see in their everyday lives when they read about stock markets.
So what's changed?
Well, recently, the rise of the semi-liquid fund, really, that's been key.
What's a semi-liquid fund?
So it's very similar to a unit trust. It was designed for private investors, and therefore it's got to look much like a unit trust. You subscribe to these funds once a month or once a quarter. You get exposure to the underlying private equity portfolio from day one. So very similar to when you buy units in a unit trust. Only difference is with a unit trust, you can buy and sell them daily versus monthly or quarterly for semi-liquid funds. But the look and feel should be the same.
Many of the top performing private equity fund managers have actually launched these types of funds, and they're doing very well, aren't they? Especially in places like America.
That's it. Yeah, I think that's the crux of it. That's the key change. So these structures have been around in small numbers, maybe a handful of semi-liquid funds for a decade or more now. But it's only recently that you've seen these mega funds in the US, of 50, 100 billion in size, weather some storms. And that's really proven the concept for the semi-liquid fund structure. And now what you're seeing is pretty much every top private equity, credit, infrastructure, and real estate investor in the world are starting to launch their own semi-liquid funds. So that's where you take the market from being a series of individual one-off semi-liquid investments to now you can have a whole range of world-class fund managers that you can build a portfolio from. So that's been the key change.
And if we look in the US, what type of investors are taking them out?
So originally it was designed for what they would term your everyday millionaires, so accountants, lawyers, private equity professionals,
Retired doctors, all those sorts
retired
of things.
doctors, exactly.
Business owners.
That's it. So yeah, everyday millionaires. But actually what they found is because they're much easier to use, they're not just easier to use for private investors, they're easier to use if you're a family office or if you're an institution. So actually you're seeing a lot of institutional investors invest in semi-liquid funds as well. And that's how they've grown to be the size they are over in the US. I think recently more than $380 billion has been invested in these structures in the US. And we think that trend is moving over to the UK. We think that's why we've launched our private market platform. We see a lot of demand for private markets in the UK now that the opportunity set is there and the products are there.
What I find is actually that when I talk to people, even within our own financial services industry, who are very high up, lots of them really, they've sort of heard of private markets, but they don't really know what it is. So let's just take a step back. What are you investing in typically? What are the different types of assets that you might get in when you're in our private fund supermarket?
So within private equity, really you can split private equity into three. So management buyouts, growth capital, and venture capital. So management buyouts are really what private equity is known for. It's the largest part of that private equity universe. This is where a firm will be buying a controlling equity stake in a private business. And these are typically very large, well-established businesses. And the private equity firm will be looking to add value to that business. Now, this business can range from being a business that's incredibly high quality, cash generative, well-established, maybe dominant in its market niche. So the highest of quality private companies, all the way down to companies that are in real financial difficulty and distress and need a turnaround situation, and really everything in between. So that's management buyouts. The private equity investors will look to operate these businesses and add value. So they might implement some form of restructuring or management change or strategy change, or they might just look at past experience. So if you're a private equity firm and you've historically backed 100 different software businesses, well, when you make your 101st software investment and you get the keys day one, you'll look back at your experience of running those 100 prior companies, and there'll be a whole roster of things that you can do day one that's going to add value to that 101st business. So there's a lot of that as well. And I think that's the key difference with private equity and just investing in a global equity fund. A normal global equity fund investing in stock markets might own some shares and just sit on them for a few years.
And have no influence.
Private equity has real influence. They've got that controlling equity stake and they can bring, there's so many different levers they can pull to create value. I think that's one of the key reasons why private equity has the track record it has over and above global stock markets.
And what other types of private equity investments are there?
So growth and venture capital, fairly similar, just different stages of business model. I think venture capital business model's a little less proven, but they both have one thing in common, and that's they're looking to back companies that are growing incredibly quickly, and these companies need capital to maintain that level of growth. So that's, in a nutshell, private equity. So that's management buyouts, growth capital, venture capital.
Yeah.
Other forms of private markets, well, there's private credit. It's a growing asset class. Simply put, that's lending money to private companies. Now that can range from something very simple, like providing a direct loan to a company that's engaged in a management buyout, or it could be something a little bit more specialist, so backing a business that's in financial distress, lending it money, so distressed debt investing, and everything in between, really. And it's a really important and growing asset class. The banks, since the global financial crisis, have been moving away from that type of lending. And in their place, you've had these specialist private credit firms rise up and take a lot of market share. So that's a big asset class now.
And you've got infrastructure, real estate.
That's it, infrastructure and real estate. Infrastructure, it's a smaller part of the private market universe, but it's growing quite rapidly. I think it's perfect for private wealth infrastructure. It's owning and operating assets that are essential to the global economy. So think, heavy asset backing, things like ports, airports, data centers, fiber optic cables, gas pipelines. So highly cash generative, predictable cash flows in their asset backed. So it's got should appeal to a lot of investors. And real estate, we all know real estate.
Well, if you just look around any major city in the world, it's packed full of buildings owned by various private equity firms.
That's exactly it. Yeah, exactly it.
How risky is it compared with investing in liquid equities?
Yeah, so that's one thing investors need to bear in mind. With private equity, it is a higher risk asset class. Now, you're still investing in companies, and within private equity, more often than not, these are still very large, very well-established businesses that have often been around for decades. It's just that they're private businesses. And so they'll share similar risks with public companies. There are probably two additional risks that investors should consider when investing in private equity. The first is illiquidity. So if you invest in a portfolio of shares, you know that tomorrow, whatever happens, you can probably sell those shares and get your money back. With private equity, it could take months or even years to plan an exit from a private business. You can't just sell one overnight. And the same goes for private credit, infrastructure, real estate. You can't just sell private assets.
And obviously, as an investor, you have no control when the manager decides or is able to sell those assets.
That's exactly it. And within the semi-liquid funds, actually, there's extra restrictions over and above a normal unit trust. So a semi-liquid fund will prevent redemptions that exceed 5% of its fund value per quarter. So if you wanted your money back and the fund had less than 5% of redemptions, you'd get all of your money back. But if you wanted all your money back and the fund had orders for 10% of its value to come back, you'd only see half of what you wanted returned to you. So there's strict redemption limits on the semi-liquid funds. So I think that's the first key risk, illiquidity. And the second one for private equity is debt. Typically, private equity firms use more debt on the balance sheets of these businesses than you'll find in public companies. And that will have the effect of magnifying positive and negative returns for investors. And it will make the companies a little bit more sensitive to interest rate shocks.
Finally, we've talked about the risks, we've talked about the choices, etc. For someone like me, is it worth investing in private equity, or should I just stick with what I know?
Well, I think the risk with sticking with what you know is that you're just focused on those 19,000 companies rather than the 140,000. So there's a huge opportunity set that you're just ignoring, basically. So I think there's that diversification argument and that sort of lost opportunity argument that says, this is a really important part of the global economy that you're just not gaining any exposure to. The second point would be, really, some of the very best investors in the world all live within private markets. And to not invest in private markets means to not invest alongside some of those managers. And I think investing in some of those managers would improve the overall quality of an investor's portfolio. So I think that's a key consideration. And if you look at the performance of the asset class, it's performed really strongly. And so I think those three key things I would use. If you're the right type of investor, if you're comfortable with the risks, I would strongly consider investing in private equity.
Jonathan, thanks very much. That's been really interesting.
Oh, thank you.
If you'd like to find out more about private equity and how you can invest, just visit our website, wealthclub.co.uk, and we've got lots of different funds available with lots of information to help you decide where's best for you.